Hey everybody, and welcome to the first video of Chapter 7. Now, Chapter 7 may be in my top 3 favorite chapters to talk about because this is all about derivatives and derivatives market. So today, we're just going to be talking about what derivatives are and give some basic terminology so that you guys aren't lost in later videos when we talk about different types of derivative instruments. So, what is a derivative? Well, derivative security is just an asset like a future options contract that derives its economic value from an underlying asset. And speculators are investors who buy and sell derivatives with the hope of profiting from price changes in the underlying commodity or financial asset. Now, this seems like something it's easy to dismiss, that it's pretty obscure. Maybe your friend day trades a little bit and says that he's invested in options, but it can't be that big of a deal, right? Well, wrong. Market analysts put the total exposure of the derivatives market at 10 times the US GDP, but actual numbers are actually really hard to come by. And the big reason for that is because derivatives markets aren't super well regulated. And I'm going to get into the semantics and details about that in the coming videos. But what I just cited is what's called the notional value or the pricing of a derivative based on the value of the underlying asset. And that notional value in 2019 was estimated to be at least $640 trillion. And that's just on the derivatives market in the United States. And how does that compare to the US GDP? Well, the US aggregate market cap alone is about $49 trillion. So we are talking about massive financial risk and financial profit to be made in the derivatives market. And what makes it really tricky is that we can't actually figure out how much at risk investors are until options or derivatives contracts expire or firms receive margin calls. And I'll get into what that means in a little bit. But that being said, it's not quite as bleak as that initial premise. That was a little bit of overhyped to get you guys interested. Now, the actual estimated market exposure that companies have when not looking at the notional value is actually quite a bit less. It's only about $12 trillion or a quarter of the US's GDP. So, still a massive number, but that's way less than 640 trillion. So, how is this possible? And that is because firms often use derivatives to do what is called hedging risk. And a hedge is just when you take action to reduce risk by, for example, purchasing a derivatives contract that will increase in value when another asset in an investor's portfolio decreases in value. So basically, derivatives can just be used to give insurance if invested properly against unforeseen events. So a lot of derivatives contracts on US markets are actually just used to decrease risk. However, there is another subset of derivatives and derivative traders that are called speculators who do what's called speculate. And speculators, they place financial bets such as buying or selling futures or options contracts in an intent to profit from movements in asset prices. So derivatives can also be used to increase speculation and investing heavily on individual market events occurring. So derivatives are a little bit of a double-edged sword. They can be good, and one of their main reasons was to decrease risk by providing insurance to companies. However, the speculation market has blossomed recently over the last couple decades and has given the US a really risky unknown side of the market where we don't actually know how much exposure is in the speculative market. Now, in this last slide, I'm just going to go over a couple terms that it's important for you to jot down or make a note of somewhere because I'm going to be using these terms quite a bit. First is to have a short position. And a short position is just the right or obligation of the seller to either sell or deliver the underlying asset on the specified future date. And a long position is the right or obligation of the buyer to receive or buy the underlying asset on the specified future date. So in every single derivatives contract, you're going to have someone who's short and someone who's long. Also, a margin requirement that I mentioned earlier. A margin requirement is the minimum deposit that an exchange requires from the buyer and seller of a financial asset. And the idea is that the margin requirement reduces the default risk that a company may have. And so the idea is that if I buy 100 US Treasury contracts, and we'll get into more language later on, but in the derivatives market, I don't need to have $100,000 to buy these contracts. I only need whatever the price is for the contract. That could be a couple $100. Well, to prevent people from just making astronomical investments without having to pay upfront, these exchanges have imposed these margin requirements to say you have to have at least X percentage of the total value of the financial asset. So that the idea is just to prevent too many defaults. But on the flip side, you can also buy on margin. So whatever makes up the margin requirement, the rest we consider to be buying on margin. So you're using debt to finance these security transactions, specifically and especially on the derivatives market. However, these margin requirements exist for the entire duration of the derivative position. So with these bonds, if the bond value changes so that I do not have sufficient bond liquidity available to make up the margin requirement, I would receive what's called a margin call, which is where the brokerage or whoever my clearinghouse is that I'm using to buy the contracts, they say, hey, you need to pay up, you need to put more money in your account, or we're going to close your position for you on these contracts. So with that, we're going to start getting into really technical substance. So take your time to really understand these concepts because it's going to get a lot trickier from here. But I'm excited. This is going to be a really fun chapter to talk about.